Chinese tech stocks are taking a bit of a hit, with major holdings like Alibaba and Baidu in a little bit of trouble here. They're moving down about 2+% apiece at the moment on fears now swirling around the stability of the U.S.-China trade truce. U.S. Treasury Secretary Scott Bessent saying earlier today that talks between the two nations have stalled. But President Trump said a short time ago that he's going to pick up the phone, or at least his counterpart Xi Jinping will, and the two will discuss it. But in a classic case of Wall Street climbing the wall of worry, look at the NASDAQ, which saw 11% vaporized over just the 2 days of April 3rd and 4th. It fell into bear market territory back then, but by May 12th, the bear was in hibernation and the index has continued to climb. And what a bouquet the month of May has been for investors. As we showed you, month to date, the tech-heavy index has absolutely blossomed, nearly 10%. While the landscape appears to be looking up for big tech, one renowned tech investor's top pick is cash. Dan Niles, the founder and portfolio manager of Niles Investment Management, joins me now. Dan, in cash you trust. When did you take that position and why?
Well, entering this year, I always do top 5 picks. And I think you had me on in January, and I talked about the fact that cash was my leading pick coming into the year. And you could invest cash in money market funds yielding over 4%. And then in early April, obviously the market was getting hit as you previewed. And I talked about the fact I thought you might see a short-term bounce, and that later in April, you were going to see earnings come in better than expected because of a pull forward in demand. And you've seen that, and obviously the market's continued to rally. I think up here, you have to remember that you saw a good Q1 because of a pull forward in demand, and now cash looks pretty darn good again with the market back to flat for the year. So we'll see how the rest of the year plays out, but that's where my current thoughts are.
But this is a living, breathing cash position, right? Because when you started to see things get really scary around April 7th, around April 8th, you took some of that cash, put it to work, and then you sold once it started to look pretty toppy, and now you're back to cash. Tell me what you're doing with that cash. You've got a big basket of shorts with several hundred stocks in them, right? Are these diversified names?
Yeah, and so when you have very volatile markets, you want to take advantage of that, both to the downside and to the upside. And so you may have some core positions that you kind of like, but if the market gets clobbered, as you saw through early April, you're going to get absolutely decimated regardless of what stocks you own for the most part. And so, as you said, it's a living, breathing position, and your positions in total should be living, breathing positions. Don't forget, NVIDIA was down 49% from peak to trough during this decline. And so if you avoided a good chunk of that and were able to buy it back near, pretty good levels, you've obviously done very well as the stock has bounced. And so I think in this year in particular, with the volatility of trade policies going on right now, investors can, if they are nimble enough, they need to be fearful when others are greedy and be greedy when others are fearful, as Warren Buffett puts it. But if you don't want to have that stress, cash and money market funds for the year is still a good place to be. You can get over 4%, or 10-year, 30-year treasuries, obviously, 4.5, near 4.5 and 5%. Those look pretty interesting as well.
And T-bills, I'm looking at a 3-month of 4.3%. You've got a 1-year at 4.1%. So these look decent here if you're nervous. But you had mentioned the pull-through, meaning the pull forward, rather, of the inventory when people were so concerned that everything was going to be hit by tariffs, so they bought up a bunch of stuff. Now, that wasn't just the actual manufacturers who needed the parts and needed the materials, but it was also the big box retailers, et cetera, and by extension, the consumer. So what do you foresee for the third and fourth quarter that has you concerned we won't see another May-style jump in the markets?
Well, I mean, if you think about the U.S. economy, it's the biggest, it's the best in the world. We're by ourselves a quarter of the world's GDP. But in Q1, because if you're a rational consumer or a company, as you pointed out, you want to get in front of tariffs that you think are coming, because that's going to drive prices up. And so what you saw in Q1 was imports for the entire US economy were up 41% year over year.
Huge,
Now, you
huge.
and I both know demand for PCs, cell phones, autos, whatever, is not up 41% year over year. And so if you went ahead and did this in advance, and that's still going on in the June quarter, because don't forget, the earliest batch of tariff rollbacks, those go away in early July, and then the ones on China go away in August. If you bought a PC, a car, a cell phone, a skateboard, skis, whatever it was,
You don't
you're
need
not going to
another
buy
one in the
that
third or
over the
fourth quarter.
exactly. You're not going to buy that over Christmas because those are durable goods to some extent. So that's going to cut demand that you see then, and so that's why I feel like the second quarter should be good because you're going to still have that pull forward in demand. And where it's going to get a lot dicier is when you getting closer to Thanksgiving, Black Friday, and obviously right into Christmas when things really are supposed to pick up. I don't think you're just going to see the demand materialize because a lot of that has been pulled forward.
Dan, there is one name that you feel you like. Well, there has to be, right? And I talked to you earlier today, and I said, just give me one thing that when you are ready to pile in, you are buying. You say Cisco. And Cisco is an interesting play here because a couple of years ago, people were saying, oh, Cisco, it's not that exciting. But tell us exactly what you see in Cisco where you would buy it now.
Sure. I mean, I think if you think about what's been the hottest theme in the markets, it's obviously been AI. And for the last 2 years, it's all been about investing in the infrastructure that creates all of this AI output and data. Well, the thing is, corporations and consumers need to get access to that. You need to move that data around, network that data. And that's what Cisco is really good at. They are the networking company. And what you've seen is that their business is starting to pick up. Their business with the hyperscalers, the Googles, Amazons, Microsofts, et cetera, of the world, they got to their $1 billion in orders with those companies 1 quarter ahead of expectations. But unlike a lot of the AI names, you're paying a 16 multiple for it. The S&P is at 23, and a lot of the AI companies are closer to 30 times. And so it's not one that people consider sexy. It's not, the first name that comes to mind. But if you start to see people think about them a little bit differently, I think it's very attractive from a couple of different angles.
Dan Niles, good to see you. You are one patient investor, but you're waiting with that cash ready to strike. But you got to wait till we see a drop. That's what I'm hearing from you. Good to see you. Thank you so much.